Thank you for tuning in to Investment Insight, presented by McCay Wealth Advisory. My name is Hayden Proffitt. Joining us today, we have Brent McCay. And Brent, current news recently is a Supreme Court case that has really gotten a lot of attention because of some potential implications of it. Do you care to hit on that case just a little bit?
Sure. So probably the most consequential thing for investors this year is not the presidential election. It's probably actually this court case. So this court case centers around a 2017 tax law where a couple in America had an investment in an agricultural business in India. They made a bunch of money in that business, but they never received any of that money. But they were forced to pay taxes on money they never received. And so the Cato Institute and a bunch of other think tanks on both right and left causes have signed this case saying, can you tax money that you have not received? Now, the implications of this are huge because if you think about many investments, obviously with an IRA, you pull money out of an IRA, you receive that money in your checking account. You have then received it. But, if you're a small business like we are, and we're an LLC, and let's say that our business, we make some money, but we never pull the money out. We leave the money in the business. We've never received the money. So is that considered taxable? Well, under current tax law, it is, because under the current LLC law, when you make the money, you got to pay taxes on it because it's considered income. So now the question is going to be, is that taxable anymore? Then the other option is there's been some bill floating around what's called a wealth tax. The idea that because your net worth went up this year, you've got to pay a percentage of taxes on what your net worth went up. Now, the hard part on that is, did your net worth actually go up? Because until you sell it, it's like anybody's like, well, I lost money in investment today. Not till you sell it. Did you make money in investment today? Not till you sell it. And so the issue there is if, with the wealth tax, the idea is we're going to tax you because money you didn't sell went up. Well, this case could have the standing to say if that is constitutional or not, or if it's not constitutional. Because a lot of people want to, quote unquote, tax the rich, tax capital. And so then also, what constitutes income? Because if receiving the money is what considered to be income, does that mean if I have an account that I just never received the money in, I don't have to pay taxes on? Does this mean that unless we actually put money in your account off your investments, that you got to pay taxes on it? So it's a big case. It's a big unknown.
Right. It has a lot of implications on just the way that the current United States tax code, the way we interpret it, the way that several accountants interpret it, it has a lot of implications on that as well, because it could completely reverse it.
Well, it could change so many years of tax law. And if you think about until the progressive era of the United States 100 years ago, you only got taxed basically on sales. You go buy whiskey, you pay a tax. You go buy tobacco, you pay a tax. When we import a tariff, a good from another country, you pay a tax. Well, most of the tax code now is based on income. You get taxed because you make money, not because you receive the money, but because you make the money. But there has to be an action where you buy or sell an investment. And so what's so consequential about this case is they could go in and say, unless you receive that money, unless that money hits your checking account, maybe you didn't receive it. And so this case will be very well watched because there'll be a lot of other rulings that are going to come with it. And it goes back to, and it's funny, this family, the Moores, is a $15,000 total tax they paid, but there's been millions of dollars and billions of dollars on the line affected based on a $15,000 tax. And another thing there too is what if you made the money overseas? What if you recognize the income in a place like the Cayman Islands where there are no taxes on income?
Right.
If you recognize the income there, that's not taxable. And that's why, so it's going to have a big impact on our investments. In the case to watch, probably more consequential than a lot of these, everyone, worries about XYZ being president, but, when you're paying your tax bill in April, that's really the bigger effect is how your money's being used, how your money's being spent. I mean, that's, what it costs for everything. And of course, it could, if they made a dramatic ruling, it could lead to a very ability for the government to tax more money. It could also lead for the government to lose a lot of income streams which means we would have a lot more deficits again.
Right. It will, if they rule one way or the other and they change the tax law, it'll affect almost every investor. It'll affect several of them more so than who is president.
And it could affect what kind of accounts you use, because right now a lot of people use, tax deferred vehicles to defer those taxes because that money doesn't come out till it is received. This could change that law where maybe there's some other vehicles that are going to be more attractive in the future.
Right.
And so this is just beginning, but this case is probably going to lead to a lot more cases that are things we'll be talking about for years to come.
Yeah, well, it's something definitely. It's another reason of why to watch the news and why to look at some scholarly articles from maybe Wall Street Journal, Bloomberg, and some of those big sources that will likely cover this case in more in-depth sources. So I think that's something to look at, and it's definitely something to keep up with here in the future. So thank you so much for tuning in to Investment Insight today, and hope you have a great day.